All right, let's get right into it. What we're talking about today is some serious market drama. You know, the kind that shows you what's really going on behind the scenes in Ethereum. In mid-December, two absolutely massive opposing forces just slammed into each other, and it kicked off a huge battle for the future of ETH's supply. So check this out. On one side, you've got BlackRock, the biggest asset manager in the world, helping to move $140 million out. And then, on the other side, you have this company, BitMains, buying up $320 million in for their own treasury. Same asset, same day. So what on earth is going on here? This is a story of market flow versus pure scarcity, and we're going to break down exactly what this clash means for Ethereum. Okay, so to really get this, we've got to start with the flow side of this fight. And that means we need to take a closer look at BlackRock's iShares Ethereum Trust. The whole thing really started with this one giant transfer. We can see it on the blockchain data, 47,500 ETH, which was worth about 140 million bucks at the time, moving right out of a wallet that we know is linked to BlackRock's ETF. Now here's where it gets really interesting. Where did that ETH go? It wasn't just sent anywhere. It landed in Coinbase Prime. And you gotta understand, this is not your typical retail account. This is the big leagues. It's a high-security playground for the pros. When assets move here, it means they're being lined up for some major financial move, like settling an enormous trade. So the immediate question is, was BlackRock just dumping its ETH? Well, no, not at all, actually. This is just how ETFs work under the hood. When investors get a little spooked and they start selling their ETF shares, these special groups called authorized participants, or APs, come in and buy those shares. Then they turn around, go to BlackRock, and say, okay, we've got the shares, now give us the actual ETH for them. And BlackRock, by rule, has to hand it over. And that's the absolute key here. This massive $140 million ETH transfer, it wasn't BlackRock's call to make. It was a direct consequence of its own investors yanking $139 million out of the fund just the day before. BlackRock was just doing its job, fulfilling its obligation, but it was a huge signal that institutional investors were getting nervous. So, why were they getting so jittery? Well, a big piece of the puzzle here is something called tax harvesting. It's a classic Wall Street move, especially at the end of the year. You sell an asset that's in the red to create a loss, which then lowers the tax bill you have to pay on all your other winning investments. It creates this selling pressure that has absolutely nothing to do with what you think about Ethereum's future, and everything to do with managing a tax bill. Now, at the exact same time all of this selling was going on, another giant was making a move in the complete opposite direction. This is the other half of our story, the world of corporate hoarding, and it's being led by a company called BitMine. And this chart, it just puts the whole thing in perspective, right? The scale of this confrontation is incredible. For every single dollar of selling pressure coming from that ETF, BitMine was slamming down more than $2 of pure buying pressure. They soaked up all that liquidity from the sellers and then went looking for more. Right as those institutional jitters were hitting their peak, BitMine announced this massive buy. Over 102,000 ETH added straight to their corporate balance sheet. This wasn't just some small dip buy. This was a $320 million strategic move. And here is their secret weapon, their strategic advantage. BitMine is doing all of this debt-free. See, a company that borrows money to buy assets can get into real trouble. If the market crashes, they might be forced to sell just to pay their bills. But BitMine, they have zero obligation to sell, ever. They can ride out any storm, which makes them a true long-term holder. And because of this debt-free strategy, they've been able to accumulate just a staggering amount of ETH. After this latest purchase, a single company, BitMine, now holds over 3% of the entire circulating supply. They are literally taking it off the market and locking it away. So what happens when these two powerful forces collide? Well, you get what some people are calling a slow-motion supply shock. All this short-term selling from ETFs is running headfirst into this massive wall of long-term scarcity being built by companies like BitMine. And what's wild is that this corporate buying spree is just amplifying a scarcity machine that's already built right into Ethereum's DNA. It's called EIP 1559. And all it means is that with every single transaction on the network, a little piece of the fee gets permanently destroyed, burned, as they call it. It's gone from the supply forever. And the effect of this is it's incredibly powerful. Since this upgrade went live, the network itself has permanently vaporized over 18 million ETH. So the total supply of Ethereum is already shrinking by design. So you see, you have this kind of dual-layered scarcity happening. On one layer, the code itself is constantly destroying ETH. And on the other layer, you have corporate treasuries now holding over 5.1 million ETH combined, just pulling more and more out of circulation. It's a textbook supply squeeze building up right in front of us. So, what's the end game here? What's the strategy behind all this hoarding? And what does this whole conflict really mean for the future of Ethereum? Well, BitMain's chairman, Tom Lee, he calls this a Darwinian phase. He basically believes we're in a survival of the fittest moment for crypto. Only the players with the strongest strategies and the most solid, debt-free balance sheets, like BitMain's, are going to make it through the volatility. And that whole survival strategy is built on a very bold prediction. Lee is on record saying he expects Ethereum to blow past $12,000 by 2026. Why? Because of the exact supply and demand crisis that his own company is helping to engineer. But, of course, no strategy is risk-free, right? A huge 50% plus market crash could seriously shake confidence. If the market retests the lows, it makes their big recent buys look poorly timed. As they get bigger, you can bet regulators will start paying a lot more attention. And, hey, what if other big companies see what they're doing and decide to copy the strategy? That could kick off a bidding war for ETH, making it way more expensive for them to keep buying. Ultimately, this battle between the short-term whims of ETF traders and the long-term vision of corporate hoarders is fundamentally changing Ethereum's market. And it leaves us with a really powerful final question to think about. If companies like BitMine actually pull this off, and they get their hands on, say, 5% of the total supply, how much faster is that supply shot going to hit the market than anyone, and I mean anyone, is currently predicting?